Everyone's chasing NVIDIA, but here's the truth. The biggest AI returns from here probably won't come from the names everybody already owns. The problem is simple. Valuations are freakishly sky high. Expectations are insane, and one earnings miss will have your gains evaporate overnight. But here's the opportunity no one's talking about. The next layer of AI. The companies powering the boom behind the scenes. I'm going to show you 3 AI stocks that could realistically deliver superior returns from here. Then I'll give you the tools to find winners like these on your own. If you're serious about finding these kinds of special investment opportunities, then hit that like button right now. It tells YouTube to show this video to more investors like yourself. Quick intro, I'm Steve Reitmeister. I've been investing for over 40 years through every major market cycle. That includes several bull markets, as well as a plethora of unique bear market environments like the dot-com bust, the 2008 financial crisis, and the 2020 COVID crash. I spent nearly 20 years as the editor-in-chief of Zacks.com covering this wide range of market environments. Now I'm a partner at WallStreetZen.com, where our quant team analyzes thousands of data points to help investors understand and outperform the market. Now that you know who I am, let's talk about the next wave of AI stocks. But first, we have to go back in time. Think about the famed 1849 gold rush. You know who made the real money? Sadly, it wasn't many of the gold miners. Many of them went broke chasing their dream of riches. Instead, the winners of the gold rush were the wide range of people selling to the miners things like lodging, tools, and food. Those were the real beneficiaries of this tremendous growth. Let's flash forward to today with the AI gold rush. The Magnificent Seven and most of the AI darling stocks have completely unhinged valuations, like the 391 PE for Palantir. That means you're paying $391 for every dollar profit, about 20 times higher than a normal valuation. That's not investing, that's unbridled speculation like 1999, just before the dot-com crash. Think of PE like a football spread. You know that the Buffalo Bills are going to beat the New York Jets any day of the week. 7 to 10 point spread is much more reasonable. Yet the insane AI valuations are like having a 50-point spread. You're just not going to win that bet. The solution is the same as 1849. Find the product and service providers to AI. Same explosive growth, yet a fraction of the risk. Now let me show you 3 stocks that fit the bill. First up, we have Tutor Perini with a symbol of TPC. The AI revolution has created explosive growth for new data centers. All that computing power needs to live somewhere. This has been a windfall for specialty construction firms like TPC, leading to explosive earnings momentum. The real wake-up call for investors happened back in May. That is when TPC had a nearly 500% earnings beat. Yes, 500% beat and raise earnings report. This kind of earnings momentum doesn't grow on trees, which is what makes TPC so special. A few more things to know. Their contract backlog sits at about $20 billion. That's future projects already agreed to. That provides exceptional earnings visibility that greatly increases the odds of more beat and raise earnings reports ahead. Wall Street analysts are excited too. That includes Stephen Fisher at UBS, who is in the top 9% of all analysts for his stock picking performance. He has a street high target of 86. A Zen Ratings also smiles on Tutor Perini, with a B rating putting in the top 20% of all stocks analyzed by this AI-driven quant model, leading to a buy recommendation. But here's what really stands out. TPC scores in the top 1% for growth. Yes, top 1%. This measure of earnings consistency greatly increases the odds of more beat and raise earnings reports in the future. They're also scoring well for key areas like momentum and safety. When you see this kind of profile, earnings momentum, backlog visibility, industry tailwinds, you pay special attention. That being said, there are still some risks with TPC, such as the possibility for construction delays due to permitting or weather or supply chain issues. Customer concentration is also a thing to watch out for, because what if tech companies suddenly pump the brakes on all that AI spending? TPC will feel that pain. Competition is heating up as every construction firm wants a piece of that data center boom. Add it all up, and I'm still pounding the table to buy Tutor Perini. That's because this company gives you access to explosive AI growth at value prices. The current $5 earnings per share estimate for the coming year is slightly conservative given their beat and raise earnings traditions. Probably ends up closer to $6 per share, which equates to fair value around $120. That is tremendous upside from where it stands now. TPC is just one prime example. I've got 2 more exciting AI plays that could deliver even stronger returns. If you'd like these kinds of insights and top picks every week, then just hit that subscribe button down below. Speaking of a steady flow of top picks, our AI-driven quant model has pinpointed over 407 stocks that have risen by over 100%. Right now, I'm identifying 3 new stocks ready to double this year using that same system. Just click the link in the description below to get these 3 stellar stocks now. Now on to stock number 2, Micron Technology. Look, in general, I veer away from adding large cap stocks in my portfolio. That's because I'm looking for serious growth that leads to a doubling of shares or more. That's much more common in small and mid cap stocks. But I could not overlook Micron. They're enjoying robust growth thanks to the AI revolution, and you can buy shares for a fraction of the valuation lavished on semiconductor peers like the beloved NVIDIA. Now, even though Micron is set to enjoy greater than 100% year-over-year earnings growth, they're only trading at a 14 times this year's earnings, right? A PE of 14. Let's compare that to NVIDIA, which has lower earnings growth of 60%, which is still impressive, but lower than 100, yet it is trading for a nosebleed PE of 38. Micron is simply the better value stock, and it happens to be the better growth stock too. Micron enjoys an impressive Zen ratings of A, putting them in the top 5% of all stocks we analyze. Drilling down into the specifics, they also score incredibly well in the following areas: top 20% growth, top 14% for financial strength, top 11% for sentiment, what the smart money thinks of them, top 7% for value, and top 4% for momentum. This proves the fundamental prowess of Micron, which greatly increases the odds of more earnings growth, more share price gains ahead. Wall Street analysts see the same thing. Most notable is Joseph Moore of Morgan Stanley, who's in the top 2% of all analysts based on his stock picking performance. Last week, he increased his price target to a street high 338. That was 40% above the current levels. But here's what's really interesting. He already had a street high of 325 on shares. But while checking his notes going into the December earnings reports, he's seeing robust demand, higher profits leading the soaring share price ahead. In fact, there are 7 Wall Street analysts who raised their estimates for Micron in just the past week going into the earnings report. They're clearly seeing great reasons for growth in the quarter and years ahead. Academic research shows that positive analyst action in the weeks leading up to an earnings report is the best whisper of a beat on the way. Before moving on, let's talk about the bear case for Micron. The semiconductor industry business is quite cyclical. Memory chips go through boom and bust cycles. That's just the nature of the business. Heavy competition from the likes of Samsung and SK Hynix could hurt market share and profit margins down the road. Plus, this is a capital-intensive business. They need to keep investing billions of dollars just to stay competitive. But overall, there's nothing semi about this thriving semiconductor company. You're getting a direct AI player at a very attractive valuation. Thus, if AI keeps growing, and it will, the demand for memory explodes, making Micron a big winner. Finally, here's the third stock I promised you, Udemy with the symbol of UDMY. On the surface, it sounds like a boring online education company, but dig deeper and you'll find they're riding a tsunami-like wave of people wanting to improve their knowledge and usage of AI to be more attractive to employers and to get a raise. This explains the attractiveness of their recently announced deal with Indeed, the massive online job site. That's a perfect match. This stock has only been falling for 4 years straight after it IPO'd in late 2021. From its $30 peak, it has now been whittled all the way down to $6. That is an insanely low price for a company that has produced 14 consecutive earnings beats. The company is fundamentally sound, cash-rich, and growing thanks to a focus on AI training where demand is exploding. When you see a stock trading under 6 with this kind of growth profile, you back up the truck and snap up shares before the rest of the world wakes up, pushing shares markedly higher. The Zen Ratings quant model is also pointing out the fundamental excellence of UDMY. Top 19% for value, top 11% for financials, top 11% for sentiment, top 9% for growth, and top 7 for our unique AI factors that point to stocks likely to outperform. This is an amazing strength across a wide range of qualities. This is not just an A-rated strong buy stock. It is actually in the top 1% of all the stocks we analyze. But let me also give you the risk with UDMY. There is real competition from free AI learning resources like YouTube. Their enterprise sales initiative is smart for sure, but sales cycles can be long and unpredictable. Plus, corporate training budgets are often amongst the first things cut during recessions. But overall, the pros far outweigh the cons. That's why I call UDMY my favorite stealth AI stock. With their 55 cents earnings estimate, plus a 35% average earnings beat, plus robust $2.61 in cash per share, it's very easy to make a case that these shares could double to $12 or more. It's time to educate your portfolio about the tremendous upside potential of this unique AI play. So there you have it. 3 exciting AI stocks, same explosive trend as NVIDIA, yet a fraction of the risk and a fraction of the valuation. As promised to you earlier, I have 3 more stocks that could easily double in the year ahead. It is available to you for free in a new special report. Just click the link in the description below. Don't sleep on these 3 exciting stocks. Last thing for today, we talked about the AI sector today, which is rife with overvalued stocks. If you want more help in spotting these kind of overvalued stocks in order to sell them before they implode, then please check out the following video.